Let's talk about something that affects almost every financial decision in your life: your credit score. A low credit score can cost you thousands of dollars in higher interest rates, and may even prevent you from achieving major life goals like buying a home or starting a business. In this video, you're going to learn exactly how to boost your credit score in just 30 days. We'll cover understanding what makes up your credit score, how to quickly identify errors on your credit report, strategies to reduce your credit utilization ratio, the right way to manage your payment history, how to leverage credit mix for quick improvements, advanced techniques that can add 20+ points in a month, common mistakes that are secretly damaging your score, a detailed 30-day action plan you can start today. Before we dive in, if you want to take control of your financial future, hit that subscribe button and give this video a thumbs up. This helps more people discover this information and supports the channel so we can keep bringing you practical financial advice that actually works in the real world. So what exactly is a credit score? Simply put, it's a 3-digit number between 300 and 850 that lenders use to determine how likely you are to repay your debts. Your score is calculated based on information in your credit reports, which track your credit history and behavior. Why does it matter so much? Because a difference of just 100 points can save you over $40,000 in interest on a typical 30-year mortgage. It affects the interest rates you pay on credit cards, car loans, and even impacts your insurance premiums and rental applications. The good news is that credit scores respond quickly to positive changes, often within 30 days, which is why we're focusing on this timeline. Problem number 1, credit report errors. About 25% of credit reports contain serious errors that can drag down your score. These might include accounts that don't belong to you, incorrectly reported late payments, or outdated information that should have been removed. Request your free credit reports directly from each of the 3 major bureaus, Equifax, Experian, and TransUnion through their official websites. Alternatively, use your bank or credit card's free credit monitoring service, as many financial institutions now offer this as a complimentary benefit. Consider credit monitoring apps like Credit Karma, Credit Sesame, or Mint, which provide free access to your credit information. Review each report line by line, marking any suspicious items. Dispute errors online through each bureau's website, providing documentation when possible. Follow up after 30 days if you haven't received a response. For complex issues, send a certified letter with return receipt requested. What makes this strategy so powerful is that credit bureaus are legally required to investigate disputes within 30 days. If they can't verify the information, they must remove it, which can instantly boost your score by 20+ points if the error was significant. Now let's move on to another problem, and this one affects almost everyone with credit cards. I want you to listen to this part very carefully because it can have the biggest immediate impact on your score. Problem number 2, high credit utilization ratio. Credit utilization, the percentage of your available credit that you're using, makes up about 30% of your credit score. If you're using more than 30% of your available credit, your score is taking a serious hit. Calculate your current utilization ratio by dividing your total credit card balances by your total credit limits and multiplying by 100. Pay down your highest utilization cards first for maximum impact. Request credit limit increases on cards you've had for at least 6 months with good payment history. Consider making multiple payments throughout the month to keep balances low. Strategically time your payments to be just before your statement closing date, not just before the due date. Here's why this works so quickly. Unlike some other factors, utilization has no memory. Your score only considers your current utilization, not past patterns. This means reducing your utilization today can boost your score as soon as the new balance is reported to the bureaus, typically at your next statement closing date. I think we've tackled that problem. Our next problem is something many people overlook, but it can seriously damage your score without you even realizing it. Problem number 3, missing or late payments. Payment history accounts for 35% of your credit score, the largest factor. Even a single 30-day late payment can drop your score by up to 110 points if you have good or excellent credit, and the impact is even greater if your score is already lower. Set up automatic payments for at least the minimum payment amount on all accounts. Create calendar reminders 3 to 5 days before due dates. Contact creditors immediately if you know you'll miss a payment. Many will work with you. If you have a recent late payment, send a goodwill letter explaining the circumstance and requesting removal, especially if you have an otherwise perfect payment history. Consolidate multiple payment dates by requesting due date changes to align with your pay schedule. The best part about fixing this problem is that recency matters enormously. While late payments can stay on your report for 7 years, their impact diminishes significantly after 2 years. Even better, a goodwill adjustment can immediately remove the negative mark if approved. Now let's move on to another problem. This one is particularly important for those who don't have extensive credit histories. Problem number 4, limited credit mix. Your credit mix, the variety of credit accounts you have, makes up about 10% of your credit score. Having only one type of credit, like just credit cards, can limit your score potential. Add a small installment loan if you only have revolving credit cards. Consider a credit builder loan from a credit union or online lender. Become an authorized user on a responsible person's credit card account. Look into secured credit cards if you only have installment loans. Don't open multiple new accounts at once. Space them out by at least 6 months. This strategy works because lenders want to see that you can responsibly handle different types of credit. Adding just one new type of account can add diversity to your profile and boost your score, often within 30 days of the new account being reported. Problem number 5, hard inquiries and new account impact. Every time you apply for new credit, a hard inquiry appears on your report, which can temporarily lower your score by 5 to 10 points. Additionally, opening new accounts lowers your average account age, which can further impact your score. Avoid applying for multiple credit accounts within a short period. When shopping for specific loans like mortgages or auto loans, do so within a 14 to 45 day window, depending on the scoring model, so multiple inquiries count as just one. Use pre-qualification offers that use soft inquiries whenever possible. Focus on improving existing accounts rather than opening new ones during your 30-day improvement period. If you need to open a new account, choose one with significant benefits that outweigh the temporary score drop. Here's the detailed strategy. If you're applying for a specific type of loan, like an auto loan, submit all applications within a 14-day period. FICO's newer scoring models count all similar inquiries within 45 days as a single inquiry, but older models use a 14-day window. By batching your applications, you minimize the impact. For the next 30 days, focus primarily on optimizing your existing accounts. The temporary dip from a hard inquiry typically recovers in 3 to 6 months, but the impact is front-loaded in the first 30 days. If you absolutely need to open a new account, choose one that offers substantial benefits, like a secured card to establish credit or a balance transfer card with a 0% APR to lower utilization that will outweigh the small, temporary score reduction. Let's quickly recap the problems we've covered and their solutions. First, we talked about credit report errors. The solution is to obtain your credit reports, review them carefully, and dispute any errors you find. This can lead to an immediate score increase if errors are removed. Second, we discussed high credit utilization. To fix this, pay down your balances, request credit limit increases, and time your payments strategically. This factor updates monthly and has no memory, making it perfect for quick improvements. Third, we addressed missing or late payments. The solutions include setting up automatic payments, using calendar reminders, and sending goodwill letters for recent slip-ups. Payment history has the biggest impact on your score. Fourth, we covered limited credit mix. Adding diversity to your credit portfolio through a mix of revolving and installment accounts can boost your score by showing you can handle different types of credit. Finally, we examined hard inquiries and new account impacts. The key is to minimize applications during your 30-day improvement period and batch necessary applications to count as a single inquiry when possible. Here's some crucial information about credit scores that many people don't realize. Your credit score can change daily as new information is reported to the bureaus. However, most lenders report to the bureaus monthly, usually at your statement closing date. Checking your own credit doesn't hurt your score. These are soft inquiries and don't impact your creditworthiness. Closing old accounts can actually hurt your score by reducing your available credit and shortening your credit history. Keep old accounts open, even if you rarely use them. Income isn't directly factored into your credit score. You can have a perfect 850 score regardless of how much or little you earn. Credit repair companies can't do anything you can't do yourself. Save your money and follow the steps in this video instead. The most effective 30-day strategy combines multiple approaches: dispute errors, pay down balances, and request goodwill adjustments. Tackling all areas simultaneously creates a compound effect. Imagine there's a small town called Creditville. In this town, your house is your credit history. Everyone can see your house from the street, and the appearance of your house determines how the other townspeople treat you. There's a town evaluator who walks around every month and gives each house a score from 300 to 850 based on 5 main features. The front lawn, payment history, accounts for 35% of your score. If there are weeds or dead spots, late payments, your score drops significantly. The evaluator cares most about how well you maintain this area. The side garden, credit utilization, makes up 30% of the score. If your garden beds are overflowing with too many plants, high balances, your score suffers. Keeping the garden neat and only partially filled improves your score quickly. The age of the house, length of credit history, contributes 15%. Older, well-maintained homes score better than brand new ones. The variety of structures, credit mix, accounts for 10%. Having only a house is fine, but adding a well-maintained garage and shed, different types of credit, shows you can manage multiple responsibilities. Finally, any recent construction, new credit applications, determines the last 10%. Too many new additions in a short time make the evaluator suspicious. Here's the thing about Creditville. The evaluator has a short memory for some things, but a long memory for others. If you clean up your overgrown garden today, you'll get credit for it on the next evaluation. But if you've ever let your lawn get completely overtaken by weeds, the evaluator will remember that for 7 years. The good news is that even if your house hasn't been well maintained in the past, focusing on mowing the lawn, trimming the garden, and making minor repairs can significantly improve your score within just 1 month, just in time for the next evaluation. And that's exactly what this video has taught you to do with your real credit score. Your credit score isn't just a number. It's a key that unlocks financial opportunities and savings. By following the strategies in this video, you can see meaningful improvement in as little as 30 days by focusing on what matters most: fixing errors, optimizing your utilization, maintaining perfect payment history, diversifying your credit mix, and being strategic about new applications. Remember, improving your credit is a marathon, not a sprint. While you can see significant results in 30 days, continuing these habits will build a rock-solid credit profile over time. If this video helped you, please smash that like button and subscribe to the channel. Share your credit improvement journey in the comments. I'd love to hear how these strategies work for you. What was your starting score, and what improvements have you seen? Drop your questions below, and I'll do my best to answer them in future videos. Until next time, here's to your financial success.